Get ready, because the future is now. We're diving headfirst into a whirlwind of groundbreaking tech and market-shaking news that's redefining what's possible. From the cutting edge of AI shaping industries to the volatile world of tech stocks, buckle up for insights you absolutely cannot afford to miss. The pace of innovation is relentless, and today, we've got the unmissable updates that are setting the agenda. You're tuned into Qualcomm Pulse, and this is your essential briefing. AI's creative edge meets industrial might. Prepare to be amazed as we explore how a leader in creative AI is making a bold leap into the demanding world of robotics and autonomous vehicle training. With backing from tech giants like Nvidia and Alphabet, this company is leveraging its powerful generative AI models to create hyper-realistic training environments. We'll break down how this strategic expansion is set to revolutionize testing, slash development costs, and what it means for the future of AI in physical systems. It's a game changer that's already attracting major industry players, and you'll want to know why. Next, we're diving deep into the fascinating, often turbulent, waters of semiconductor stocks. We'll analyze the recent market movements, focusing on key players like Nvidia and Broadcom as they navigate critical technical levels. Discover how moving averages are providing crucial signals for investors, revealing support and resistance points that could dictate the next big moves. Are these tech titans poised for a comeback, or are we seeing a shift in the landscape? Get the inside track on what the charts are telling us. Then, we get a masterclass from a billionaire investor who's sticking with the titans of the AI revolution. We'll unpack his strategy for holding onto massive winners like Nvidia and Microsoft, even amidst market fluctuations and geopolitical headlines. What's the conviction behind these long-term plays? We'll explore the fundamental strengths and analyst outlooks that make these companies continue to dominate, and what this means for your own investment horizon. Finally, we confront a surprising market reaction to a major player's performance. After a stellar earnings report, one tech giant saw its stock dip, raising questions about market expectations and the volatility of even the most dominant companies. We'll dissect the numbers, the forecasts, and the market's immediate response to understand what's really driving these movements and whether it presents a new opportunity. You won't want to miss these critical updates. Hit that subscribe button, ring the bell, and let's get started. AI's new frontier, robotics training gets a generative boost. Runway AI, a name synonymous with cutting-edge creative tools, is making a significant pivot into the high-stakes world of robotics and autonomous vehicle training. This strategic expansion, bolstered by substantial backing from industry titans like Nvidia and Alphabet, marks a new chapter for the New York-based company. With a valuation of $3 billion and over $500 million raised, Runway AI is leveraging its advanced generative AI capabilities, particularly its prowess in creating consistent, up to 30-second video clips, to address the complex needs of the robotics sector. The move is strategically timed, aligning with robust growth projections for the simulation market, which is expected to surge from $15.1 billion in 2025 to $44.3 billion by 2034, with the autonomous vehicle simulation segment alone projected to hit $7.3 billion by 2034. This expansion into robotics training is not about building new models from the ground up. Instead, Runway AI plans to fine-tune its existing world models, adapting them for the specific demands of training robots and self-driving systems. The core advantage lies in the company's expertise in visual generation, enabling the creation of highly realistic and varied simulation environments. Such environments are crucial because real-world testing for robotics and autonomous vehicles is notoriously expensive and time-consuming. Simulation allows engineers to isolate and test variables with precision, a feat difficult to achieve in live, uncontrolled settings. This approach promises to accelerate development cycles and reduce costs significantly. The competitive landscape is already heating up, with Nvidia itself entering the fray with its Cosmos world models. This creates an interesting dynamic of both competition and potential collaboration, given Nvidia's investor status in Runway AI. Similarly, Alphabet's involvement through its Waymo unit suggests a keen interest in this burgeoning market. Other established players in the simulation software space, such as Ansys, Siemens, and Autodesk, will likely feel the impact as demand for these advanced training solutions grows. While Runway AI remains a private entity, its strategic direction offers valuable insights for investors tracking the broader simulation and robotics industries. The strong endorsement from Nvidia and Alphabet underscores the long-term potential they see in generative AI's application to physical systems. This move by Runway AI is a clear indicator of a broader trend. Generative AI is no longer confined to creative applications. It's becoming an indispensable tool for developing the complex technologies that will shape our future. But this isn't the only seismic shift happening in the tech world. Stay with us as we analyze the critical movements of semiconductor giants. Semiconductor stocks dance with moving averages: Nvidia, Broadcom, and the market's pulse. In the dynamic arena of semiconductor stocks, recent market activity has put key players like Nvidia and Broadcom under the spotlight, especially concerning their interaction with crucial technical indicators. Many semiconductor stocks, including Nvidia, Broadcom, and Lam Research, experience sell-offs, yet they, along with 14 other companies, maintained their positions on Qualcomm Pulse's leaderboard. This resilience occurred even as inflation data failed to present any alarming signals to the broader market. The focus on chip stocks intensified as Nvidia and Lam Research saw their prices gap down below their 50-day moving averages, while Broadcom managed to find support and bounce off this significant benchmark. Moving averages are more than just lines on a chart. They serve as vital benchmarks that help investors identify potential support levels where buying interest may emerge and resistance levels where selling pressure might increase. This makes them invaluable tools for timing market entries and exits. The current actions of IBD leaderboard members, including giants like Nvidia, Broadcom, and Alphabet, illustrate this principle vividly. Nvidia's gap down at the start of the trading week, following its earnings report, raises questions about its ability to reclaim its 50-day moving average, a key indicator of underlying strength. For Broadcom, its ability to bounce off the 50-day line, as it did previously, suggests a level of resilience, though its upcoming earnings report will be a critical test. Many other companies on the leaderboard are also testing these critical moving averages, with some falling below and others struggling to hold their ground. Conversely, stocks like Google, JP Morgan, and Wheaton Precious Metals are trading comfortably above their 50-day lines, indicating sustained positive momentum. Even broader market indices like the Nasdaq and S&P 500 are above their 50-day averages, but are currently facing resistance at their 21-day exponential moving averages. For investors, navigating this environment requires a keen eye on these technical levels, especially for companies like Nvidia and Broadcom, as they attempt to weather the current volatility. Risk management remains paramount, and understanding how these stocks interact with their moving averages provides critical insights into their immediate prospects and the overall market sentiment. But the market's narrative isn't just about technicals. It's also about the strategic conviction of legendary investors. We're about to dive into one billionaire's playbook. Billionaires' bullish bet. Ken Fisher doubles down on Nvidia and Microsoft amidst market flux. In an era defined by geopolitical tensions and shifting economic landscapes, billionaire investor Ken Fisher remains steadfast in his conviction, holding significant stakes in two of the market's most influential tech giants, Nvidia and Microsoft. Fisher, with a substantial net worth and a prominent role at Fisher Investments, views the current market, despite headlines warning of tariffs and inflation, as a classic bull market. He argues that forward-looking stocks have a remarkable ability to discount worst-case scenarios long before they materialize. Fisher posits that the market's resilience, with indices like the S&P 500 recovering from earlier dips and reaching new highs, is not a sign of ignoring reality, but rather a reflection of stocks pricing in a more favorable outcome than initially feared. This perspective frames the current environment as one where, within a bull market, trimming positions is sensible, but holding on to top performers is the optimal strategy. Nvidia, often dubbed the picks and shovels provider of the AI revolution, has cemented its status as the world's most valuable company. Its journey from a gaming GPU pioneer to the indispensable supplier of AI chips is a testament to its strategic evolution. The company's success is built not only on its powerful hardware, but also on its robust CUDA software, which has become the industry standard for AI development, creating a formidable full-stack ecosystem. Despite a recent quarterly report that, while strong, didn't meet exceptionally high expectations, leading to a temporary share price dip, Fisher maintains a substantial position. He recently trimmed his stake but still holds over 82 million shares, valued at approximately $14 billion. Wall Street analysts largely echo this optimism. Sebastian Nagy of William Blair, for instance, highlights Nvidia's consistent growth driven by hyperscaler spending and emerging demand from neocloud, sovereign, and enterprise clients. With new chip architectures on the horizon, Nagy sees a favorable risk-reward ratio, rating the stock a buy with a price target suggesting significant upside. This bullish sentiment is widely shared, with a strong consensus among analysts supporting Nvidia's continued growth trajectory. Microsoft, the second most valuable company, complements Nvidia's hardware dominance by focusing on the application and deployment of AI. Its cloud services, particularly Azure, and its pivotal partnership with OpenAI have positioned it at the forefront of integrating AI into practical business solutions. While concerns linger about the time it takes for massive AI investments to translate into substantial revenue growth, Microsoft's recent financial results have been impressively strong. Revenue growth has accelerated, with Azure's performance notably exceeding expectations. Fisher also holds a significant stake in Microsoft, having made a minor trim in the last quarter, retaining shares worth around $12 billion. Analysts like Gil Luria of D.A. Davidson emphasize the symbiotic relationship between Microsoft and OpenAI, noting how it drives Azure's outperformance. Luria maintains a buy rating, projecting considerable growth for the stock. The consensus among analysts is overwhelmingly positive, reinforcing the view that both Nvidia and Microsoft represent compelling long-term investment opportunities. But even the most dominant players can face unexpected market reactions. We're turning our attention to a surprising dip after a strong performance. Alibaba's AI chip surprise sends Nvidia tumbling below key technical levels. In a surprising turn of events that sent ripples through the tech market, Nvidia's stock experienced a significant drop, falling below a crucial technical level following news of Alibaba's advancements in custom AI chips. This downturn occurred shortly after Nvidia released its second quarter earnings report, which, despite exceeding Wall Street's expectations for both earnings and sales, presented a revenue outlook for the current quarter that was only slightly higher than anticipated. This conservative forecast, coupled with the unexpected competitive development from Alibaba, triggered a sell-off, raising critical questions for investors about Nvidia's future trajectory and whether the stock remains a viable buy. Nvidia's second quarter performance showcased robust financial health, with earnings per share reaching $1.05, surpassing the consensus estimate of $1.01. Revenue also topped expectations, indicating strong demand for its AI-centric products. However, the market's reaction was notably muted, and the subsequent decline suggests that investor sentiment is highly sensitive to even minor deviations from exceptionally high expectations, as well as emerging competitive threats. The announcement that Alibaba has developed its own custom AI chips signifies a potential shift in the competitive landscape, particularly within the massive Chinese market. As a major cloud provider and technology conglomerate, Alibaba's move into custom silicon could reduce its reliance on external suppliers like Nvidia, impacting future sales. This development highlights the increasing trend of major tech players investing in in-house chip design to optimize performance, reduce costs, and gain a competitive edge. For Nvidia, whose growth has been intrinsically linked to the booming demand for AI infrastructure, any significant challenge to its market dominance, especially from a player of Alibaba's stature, warrants close attention. The stock's breach of its 50-day moving average, a critical technical indicator often signaling a shift in short-term momentum, underscores the market's immediate concern. Investors are now closely watching whether Nvidia can regain this key level and demonstrate its ability to navigate this evolving competitive environment. The situation underscores the inherent volatility in the high-growth AI sector, where rapid technological advancements and strategic moves by industry giants can quickly alter market dynamics. While Nvidia's core technology and market position remain strong, this event serves as a reminder that the path forward requires continuous innovation and adaptation to remain ahead of the curve. That's a wrap on today's deep dives into the tech world. But before you go, let's quickly recap the biggest stories. And that's a wrap on today's pulse-bounding tech updates. We saw Runway AI pivot into robotics training with major backing, semiconductor stocks like Nvidia and Broadcom navigating key technical levels, billionaire investor Ken Fisher reaffirming his faith in Nvidia and Microsoft, and a surprising market reaction to Nvidia's performance amid new competition. Don't miss out on future insights. Hit that subscribe button, ring the notification bell, like this video, leave a comment with your thoughts, and follow us on all social platforms for continuous updates.